Sectors has been a place where there's been a lot of, I would say, volatility of performance between the different sectors. Obviously, we've seen at the very beginning, and I would say for H2 almost, a lot of positive momentum for value type sectors, for energy, for financials. It's been coming down during the summer. We saw a bad week for energy last week. It's coming back this week, as you were mentioning also on oil prices. I think we're still on some degree of, careful cyclical type of exposures, but we would also start looking at, and we've seen that in flows in particular. Some people are coming back to technology, so kind of growth stocks as well, which is an interesting signal. So there's still money going into equity markets are rallying still, but there's maybe a little bit more of a caution that we're starting to see happening in the market, especially as we go into more tapering discussions.
Yeah, Antoine, very nicely. Look, the real world doesn't pay Fed rates. The real world pays like our previous guest, who represents a medium-sized company. They paid 8% on his old finance, 5.5% on his new finance. He was talking to us as well. So I'm going to ask you this. Is this the world that's got things around the wrong way? Is actually the impact of the liquidity being taken out from quantitative easing, from the so-called tapering, is that potentially much greater than the impact of as and when we do get rate hikes, because they're going to be so glacial anyway, and they're not going to affect the majority of real businesses in the real world anyway? So actually the impact on liquidity and what it can mean for markets, far greater potentially than interest rates. There you go.
It is definitely important. Well, one of the key things, so that could worry the market. At the same time, the withdrawal of liquidity, I mean, we're looking at they're buying close to $1 trillion on a 3-month basis, average basis at the time, if you're looking just at the largest central banks, excluding the Central Bank of China. So that's a lot of money that is being put into the market. That's kind of like almost close to the peak of the previous QE periods back 10 years ago. So clearly, this is something that is helping the market, is holding the markets. But there's also the reinvestment of all those balance sheets, because those balance sheets are gigantic. And you've got to reinvest the bonds that mature. You've got to reinvest the coupons. So there still is a little bit of a flow that is supporting the market that helps keep yields at a lower level. It doesn't mean that yields will not go up, but it might not be a kind of explosion in yield because they are starting to taper. There still is a lot of technical pressure that is keeping yields a bit lower than they would normally be, given the rate of growth we're seeing.
Is there a liquidity problem? I know the FT's been going on about it for a couple of days. Is there a liquidity problem in the markets, which means that we are going to have volatility?
That is definitely a potential source of volatility, and that's something that we've been arguing in our outlooks in terms of saying, keep a kernel of caution, and volatility could be one of the spaces which could clearly impact us. So that's why we like to buy an edge against implied volatility through convertible bonds as well, and through some types of strategies. That is potentially a risk to look at. Especially if liquidity is thinner, and liquidity is seen in the month of August as well. So just like we need to bring that into perspective. There may be a bit more liquidity when we come back. Everybody comes back from holiday in September. It probably will be needed if there's more news to come from the FOMC meeting in particular later in September.